Hey, we're gonna try this again. I just had a couple of technical issues here where I was quite a bit dumber than the machine here, which is funny because it plays exactly into the topic I was just discussing. But I'm gonna go back over to the beginning. Let me know if you guys can see this because I was a good say 5 minutes into the presentation over there. I just want to make sure that that people can see this one. I'm gonna hop over on my phone and just make sure that that it's coming through okay because that was super weird. I was in like the wrong there we go. So it looks like it's showing up. Sorry about that. I was over on Eric's profile. I thought I was presenting into the group, but something was messed up in the software on the back end. So hopefully we can get this chopped up and edited a little bit so it's a little bit cleaner. And sorry, I'm a couple minutes late. The good news is this is a shorter presentation, so it should work out okay. Let me know if you can see this and if you can hear me. I'm gonna make sure that that we get copies of this up on YouTube a little bit quicker and stuff for anybody that missed it or just link to it. So anyway, what we're talking about today is paying down debt or investing. And it's a question we're getting a lot right now. It's a question that I've gotten a lot for years, but specifically right now with rates being a lot lower and with the market being a lot higher, people tend to be having a little bit harder time with this. So we're going to talk about the math. We're also going to talk a lot about the psychology. And this is a question that's never going to go away. Okay? So this is not something that is just a temporary thing, but what I'll say right off the bat is if we were all robots, so if we were all perfectly rational decision makers, this decision would be pretty easy. You'd basically say, look at the effective cost of your debt. If it's less than the expected rate of return on your investment, then you should invest the money. So as an example, if you have a mortgage at 5% and stocks are doing 12%, you should probably invest. You know, if it's the 90s and you have a mortgage at 5% and it's deductible, so you're really only effectively paying 4%, let's say, after your tax deduction, and stocks are doing 30, 40, 50% a year, this is pretty easy, right? Just invest the money, pay the minimum on the mortgage and be done with it. But of course, sometimes it's the other way too. Sometimes the effective cost of the debt is much higher than the expected rate of return on the investment. And in that scenario, you'd want to pay that debt off. So this is all pretty straightforward so far, right? If you had credit card debt at 18 or 20% and you had money in the bank making 1%, you'd be much better served taking whatever the free chunk in the bank is that you don't need for like food this month. You should take that money out, pay the credit card debt off. I think that's all pretty straightforward. But the big thing is here, of course, the obvious 900-pound gorilla in the room is that humans are not robots, and myself included. I mean, we are, as a species, I would say we're very intelligent, but that doesn't equate over to rationality or logic really at all. I mean, we're capable of the reasoning, like we're usually able to know what the better decision is, but we struggle with actually implementing and having the discipline to stick with that decision. And Warren Buffett actually has said some of the smartest, most intelligent, most rational people you know will make some of the biggest decisions in their life in the least rational ways you can possibly imagine. So they might be a CEO, they might buy another company because they like that CEO. You know, they might change jobs because they like the branding of the new company or something. You know, there's some crazy underlying components in the human mind that underline a lot of our decision making, and we are really much more emotional creatures than we are mathematical and rationality driven creatures. So I'm going to move forward here. This is Dave Ramsey. A bunch of you probably know who he is, and he's a little bit polarizing. Some people love him, some people hate him, but I like him a lot, especially in the debt world. So the main reason I bring him up is because a lot of people will come to me and they'll go, hey, you know, Dave Ramsey said that I should just always pay down debt. If I have free cash, I should always pay down debt. And that's stupid, right? Because if my debt's at 3% and I can go make 6 or 7 or 8 or 10%, I should go make the investment, right? And I hit time out here a little bit. So I say, Dave Ramsey, you can go look him up. He's probably worth, you know, $300 or $400 million. Go look it up. I'm not really sure, but he's a very intelligent guy. He's made all of his money in the financial advising. You know, he's not a financial advisor, but in the financial thinking, financial advice space is where he's made all of his money. So what I would ask is, do you really think that Dave Ramsey doesn't know how that debt payoff calculation works. So the stuff we just went through about how if your debt rates are lower, you should keep the debt. If your debt rates are higher than your investment, you should pay it off. No, and the answer is, of course, he knows all the math. 100% chance that Dave Ramsey knows how all the math works. He's just playing the next level game. And the next level game is throw the math out the window. What is the human psychology going to do? What is the behavior of this smart chimpanzee? What are we going to do? And what I want to do for a second is kind of take an imagination journey here with me. So imagine you have $200,000 on a mortgage loan that's outstanding. I mean, you owe 200 grand. You're paying 3.5% interest. And now pretend with me that you have 250 grand in the bank, and you're debating on taking 200 grand out of the bank and just either investing it in stocks or paying off the mortgage. So Dave Ramsey would right away, he's like, you're crazy, take it out, pay off the mortgage, you're done with it. But some other people are going, if I pay off the mortgage, I'm only getting 3% on it. I think I'm going to go put it in stocks. I bet, again, gamble here, I bet that I'm going to do better than 3%. So you put your 200 grand in stocks, and of course, what happens on this journey here? You invest the 200 grand in stocks, it quickly falls 80 grand to 120 grand. Okay, so what I want you to really try to visualize now is, how do you feel in that situation? You had the chance to be mortgage debt free. You had the chance to, your cost of living was only going to be utilities and property tax and food and entertainment and stuff. Like you probably have a significant bill now that you could have chose not to have. So a lot of people here are really going to beat themselves up in this scenario. So just for some fun here, I have Joe Exotic over here on the side where he's going, I am never going to financially recover from this. This is how a lot of people feel in that scenario. They go, oh my gosh, I could have screwed up, or I screwed up. I could have been debt free. And just to think about it, every single time that mortgage bill comes in and you write another check to the bank and send that check off, you feel like you lost that money. Oh my gosh, I could have had that paid off. I have to pay. Question for you is, does the robot feel that way? And the answer is, of course not. The robot rides it out. In fact, the robot might go borrow more money to buy more stocks in that environment. So I want to be clear about this. We are not robots. We are not going to behave rationally at all. In the stock market, when everything falls in value 30, 40, 50%, it should be like you're at a grocery store, where if everything in the store suddenly dropped 50% in value, you would load your cart up, right? But a lot of us as human beings with stocks, when the stocks drop 50%, we run out of the store. We just sell everything. We throw our whole cart on the floor and we run out the door because we're scared. So I'm not telling you to put all your money in the market and just hope it's all going to work out. I'm not telling you that at all. What I'm saying is, from a psychological perspective, so if you think about this as honestly as possible about what humans are likely to do, paying down debt is almost always the right answer. Okay. And that really offends a bunch of financial advisors and a bunch of other people that, like to sell investment products. So it's that old line that it's really hard to get someone to see your point of view if their paycheck depends on them seeing it their way. I think that's another Buffett line. Like, if they're getting paid to see it their way, it's really hard to change their mind. So what I'll just say, as a fiduciary, as an advisor, I am way more likely to recommend you pay down debt than I am to tell you to invest. And that's not necessarily just because of the current environment, but we're going to talk about the current environment next. Really, the reason I'm doing that is because I am focused on reality. I'm focused on behavior, and I'm not necessarily focused on theory. I'm focused on what you're actually going to do when the live bullets start flying. I'm not as focused of like what it looks like in a pretty chart. Okay. So today, in my opinion, this decision is very easy. Why? Well, number one, I have fully valued plus. I'm not going to say stocks are in a bubble. If you saw my last video, our stocks in a bubble for, I don't know if that was last Wednesday or the Wednesday before, the last Wealth Wednesday. I'm not going to say they're in a bubble. I'm not going to say they're overvalued, but I will say that they're probably fully valued. And in fact, if you look at what a lot of the best market minds in the world are saying, so if you can read, I don't know if you can read this fine print down here, but it says this is a 10 to 15 year horizon. So they went out and they asked BlackRock, JP Morgan, Morningstar, research affiliates, which is a bunch of PhDs, and then they asked Vanguard, how do you think stocks are going to do over the next 10 to 15 years? BlackRock said 5% a year, JP Morgan said 4% a year, Morningstar said we think stocks will be down over the next 10 years, which I think is insanity. Research Affiliate said 2%. Vanguard said 3.7 to 5.7. So a couple takeaways here. I think it's hilarious that JP Morgan put the 0.10. So they go, we think stocks are going to be down we think stocks are going to be up 4.1% a year over the next 10 years. Just say 4%. What are you doing predicting 0.1% over a 10-year period? That's ludicrous. I like Vanguard. I like how they kind of gave a range there. I wish they would have made it simpler and just said, hey, we think 3 to 6%. My point is, the reason I show you this slide is that I think it's really unlikely stocks do 12 or 15 or 20% a year from here. I think it's very likely from this point in the cycle that we do 3 or 4 or 5% a year going forward. So, and that's going to be a bumpy ride to go get 3 or 4 or 5%. So now the good news is that's one of your best options out there right now. Like you're not going to put it in bonds at 1% or something. Like I still think it's rational to own a lot of stock right now. I own a ton of stock right now. But my point being, if I thought the market's going to do 4% a year and my mortgage is at 3.5% a year and I'm close to retirement, I think it's kind of crazy to think that you're going to use the market to beat your mortgage. I think you should just pay the debt down, right? So I think there's some other things going on here too. So like mortgage debt is also non-deductible right now, at least under the current tax code. That might change by the end of the year, but mortgage debt non-deductible, meaning if your interest rate's 3.5%, it's actually costing you 3.5%. It used to be deductible where if you had a mortgage at 3.5%, it might only cost you 2.5% to 3%. So what I'm saying there is because of mortgage interest not being deductible, that essentially makes mortgages more expensive, meaning it tips the scales in favor of paying down debt even more. Also, you have CDs. I have 3%. You're not going to find a 3% CD anywhere. I mean, you're probably talking 1 or 2%. Bonds are yielding less than 3% right now. So that's just the yield, by the way. So meaning with bonds, you get an interest payment every year. So let's say you put $100 in a bond, it's yielding 3%. You're going to get $3 in interest every year. But you also have interest rate risk with a bond. So what I mean here is that if interest rates go up on this teeter-totter or seesaw, depending on what part of the country you're from, if interest rates go up, the prices and values of the bonds go down. Okay, so this actually, if we expand the table, we're going to come back to that one. If we expand this table a little bit, bonds here, you're going to notice that this table actually included developed stocks, meaning this is like Europe, Japan, places like that. Emerging markets, this is like China, Vietnam, Africa, different places like that. And then over here, US bonds. Look how these people are saying bonds are going to do. They're saying bonds are going to do 0.8%, 2%, 1%, 1%, and 1.75%. That's over 10 years, 1% a year for 10 years. That is nothing. You're way better off if you have money in bonds and you have debt. My question to you would be why? Why are you taking a 1 or 2% rate of return when, unless it's a car loan or some sort of loan at 0%, that you're much better off taking that money that's earning almost nothing in bonds and throwing it at the debt to wipe out the debt. Now I'm going to take as a joke. If you listen to any Rush Limbaugh, you've probably heard the obscene profits timeout. But what I'm going to say is if there was a vehicle, so if there was something that existed as an investment that was really likely to beat bonds. So like from a historical standpoint, you look at it over the last 50 years, you look at how it's capitalized, you look at, really pop the hood. Maybe there's a whole book on this topic, but if it was really likely to beat bonds over a really long track record and it was as safe or safer than bonds, it might change the line of reasoning in this presentation. So what I mean by that is if you could get 4 or 5% with no principal risk, that might change the debt payoff conversation. Okay, so I just want to say, if you're curious at all about that, go back in the group, check out our video, the Wealth Wednesday that I did on the new 60/40, which was a Wealth Wednesday where I just presented a bunch of the topics in my book, the new 60/40, which is on Amazon. It's like the number 14 seller in retirement planning on Amazon. But go in there, check it out. It will change some of the calculus behind this, but at the end of the day, this really all comes down to human psychology. Okay. It really all comes down to right here. We are not robots. Okay. We are not going to make the perfect mathematically optimal decision in any situation. In fact, we're very likely to make, in some cases, the opposite of the most rational decision. So what I mean by that is we're very likely to take this money invested in stocks, have the stocks crash, and then sell out of stocks and lock in this giant loss, where the computer, if you will, the robot, might have just rode it all the way back out to the top. Whereas the person not only makes the mistake of not thinking about their own behavior, thinking only in terms of what the theory says and then getting themselves into a big losing position, but then they compound that mistake with another mistake. They compound that mistake with selling again, you're selling at the bottom, which is almost a more expensive mistake. Like buying with the Dow at 25,000 is one mistake if it goes down to 20,000 during the coronavirus and stuff. But let's say it goes from 25 down to 20. You made a mistake buying it at 25, but then you made a second mistake selling it at 20. Okay, well, the thing to do was buy at 25 if you have a 30-year time horizon. If you have a 1-year time horizon, which I think is insanity, but if you have a 1-year time horizon, buying at 25,000 was a mistake. And here's the thing in all this stuff in financial markets, almost everything you do is a mistake to some degree. So if you pay $100 for a stock and it goes to $200, you made a mistake because you should have bought way more of it. Okay, you didn't buy enough of it. If you pay $100 for it and it goes down to $50, you obviously made a mistake. But then what if the company is actually better? So it goes from 100, it goes down to 50. Now the company's actually better, the stock is better, the business is better, but the price is still down. You're actually better off buying more there, where a lot of people just, kind of throw it aside. So everything you do is going to be a mistake to some degree. What I would suggest you do, especially in regards to debt, is where was it here? Follow this guy's advice right here. Follow Dave Ramsey. Focus on the psychology. Focus on how you're going to feel if you get the investment decision wrong. And I think for a lot of people, paying down the debt literally is almost always the right move. Here's a couple times that it wouldn't be. Let's say you had a lot of student loan debt right now, and there's a lot of talk in Congress right now of potentially getting student loan debt paid off. If I had student loan debt, I would probably be tempted to let it linger around a little bit. And let's see what Congress does. Let's see if I can get out of this debt literally for free. But that's just me. Do know that if it takes them a year to do something on it and your interest rate is 6%, you did still just lose 6%. So there's a lot of things factoring into this decision. But what I will say is most people do not place enough weight on the psychological component to the debt pay down decision, which again is almost always going to favor paying it down early, unless for some reason, like I said, maybe you think that the government's going to pay it off for you, or maybe you think, maybe it's a very, very small loan and it's at 0% interest or something like that, hey, out of my paycheck in 6 months, I could just stroke a check and pay the whole thing off. Like we had to get a new furnace in our house, and I did the 0% financing. I'm paying way above what the payment is. The payment would only be, I don't know, like $20 a month or something. And I'm paying $1,000 a month to get it wiped out. But I did it just from the standpoint of having the flexibility. So if, as an example, let's say right now that you're 50 and you're watching this, and maybe you're thinking you're 10 years away from retirement, it might make more sense. This is going to sound crazy, but it might make more sense to do a 30-year mortgage and make double payments on it, or even higher than double payments on it, just to have that flexibility where if 2 or 3 years in, let's say 2 years from now, something happens at work and you lose your job, you would have the flexibility basically to radically reduce your mortgage payment, and you wouldn't have just burned up all of your savings. You'd be much more liquid, and you'd have that flexibility to basically pull a lever and make your costs go down month to month. So these are different things to think about. I would say in general, if the money is just going to get used on an investment or on purchasing something fun or whatever, you're better off taking that money and paying down the debt. So that's my 2 cents as a fiduciary, as a financial advisor here. If you have some questions, if you want to learn more about bonds, I'm sure we have a couple videos, comment on the video. I'm sure we have a couple other Wealth Wednesdays we can get to you. If you want to see some vehicles that are potentially better than bonds, comment down on the video and we'll link you up with that Wealth Wednesday I did on things that are better than bonds. And but Oh, okay. I guess there wasn't a 17th slide. I thought there was a big drum roll on the 17th slide. But the one thing I'll just say right now, as you're looking at this chart too, if you have bonds, I want you to really ask yourself why. If you own bonds right now, why do you own them? What is your goal? What are you trying to do? I mean, inflation right now in the US is really low, and bonds still can't keep up with inflation. You know, BlackRock up here, they're one of the biggest bond fund companies in the world. I think they might be the largest bond manager in the world. And they're saying bonds are going to do 0.8%. But if you're paying an advisor 1%, so you're making 0.8 on your bond, you're paying him 1%. Well, now you're moving backwards 0.2, right? And now if we add on 2% of inflation, now you're actually moving backwards 2.2. Okay, so if you own bonds, I want you to really ask yourself why, and think about if you have debt. If the bonds are in an IRA, that's a different thing. You don't want to take a penalty to pay down debt. But if the bonds are sitting in like a non-qualified account, or like individual brokerage or joint brokerage, or maybe even potentially, depending on the situation, if you're over 59 and a half or something, could make sense even if they're in a Roth. Now, Eric's probably wincing as I say that a little bit, but every decision you make, sure, do the theory on it, think about the math, think about the calculations, but then at the end of the day, ask yourself, if this thing starts going sideways, am I likely to compound my mistake, or am I likely to hold fast and ride this thing out? So that's what I got for you this week. Sorry, it was a little messed up on the beginning with I think the original video was getting sent out just to like Eric's personal profile or something. And I think I'm probably going to find some new software to do these on, but because I really like streaming live, especially to be able to get the feedback and see the comments and all that type of stuff. But thanks everybody so much for joining us on the Wealth Wednesday this week. We'll be a little bit more organized for next week, because we'll have Eric do it, or I'll have Eric set it up for me to do it. So we'll be on time and won't have as much of those difficulties on the front end. But thanks so much for joining. Thanks for being part of the Retirement Mastery Group. If you know anybody else that you think could get value out of the group, invite them, or tag them on one of these videos. I'm not sure if that'll work. They might have to be in the group to see it. But let Eric know, let me know, let Connie know. And one last thing, by the way, if you're already working with us and you've had any interactions with Connie, it's Connie's birthday today. So make sure we all give Connie a real happy birthday, send her some messages, and let her know that she's appreciated around here, because she's pretty much the reason that this business hasn't gone down in flames already this year. She keeps everything running. So thanks so much, everybody, for joining us. And always remember, you don't need more money. You need a better plan. You need a plan that takes your behavior into account, and you need to kick bonds out of your plan. That's one quick way to make your plan better. Thanks so much for watching, everybody. Take care.